Hi, good evening, everybody. Welcome back for our live market commentary. This is where we talk about the latest developments in the financial markets, and this is where we share our views on them. I'm Albert. I'm the Deputy Country Manager here in Stashaway, Malaysia. I'll be your host for today's session, and as usual, we are joined by Stephanie here, our Chief Investment Officer. Hi, Stephanie. How are you?
Hi, I'm good. How are you doing?
Good, doing well, very well. It's been a month ago when we were doing this session in person in Malaysia itself, and now we're back to doing it online. So, yeah, I guess time flies.
Yes, indeed. Hopefully, we'll be able to do some more in-person market commentaries in the future. But
Yes,
meanwhile, I mean, markets have been very exciting.
very, very exciting
Been
indeed.
keeping us very, very busy.
Yeah, and for today's market commentary, we're going to be focusing on the bond market itself. And as we have been discussing over the past market commentaries, we've seen high inflation over the last 1.5 to 2 years. We have seen the Federal Reserve or the central banks all around the world hiking interest rates as a result of that high inflation. One implication of that is we've seen a lot of volatility in bonds itself, right? If you take the 10-year US Treasuries, for example, at one point in time, they were yielding about close to 0.5% in 2020. Not too long ago, they hit 5%, and more recently, they have come back down to 4.5% yield. So, one of the things that has been, I guess, mentioned or touted around, Stephanie, is this yield curve inversion. And some of our audience out here may have heard about it and could have read that this could serve as a precedent for a recession itself.
Hmm.
And we've also gotten some economic data that has come in recently pointing towards a recession, weaker labor market, some purchasing manager index coming in at not so great levels. So perhaps Stephanie, could you elaborate a little bit more on this?
Yes, I mean, indeed, as Albert said, there's been a lot of volatility in the bond markets, and I mean, it hasn't been an easy 12 to 18 months being a bond investor. Indeed, if you look at the current drawdown of bonds in aggregate, bonds are down roughly around 15% from its highs. And just looking back at history, this is the biggest drawdown bonds have ever seen in the past 40 years. So the last time we had such a big drawdown, you need to go back to the 70s when inflation was actually a major concern. So for most of us, actually, we haven't experienced this before. And I think, of course, like we've been continuously talking about the reason for this, which is a high inflation number prompting the Fed to aggressively raise interest rates. And as Albert said, I mean, just a short 18, 24 months ago, we were looking at interest rates close to 0%. Today, given the rise in long-term bond yields, in October, for example, both 10-year rates and 30-year rates actually touched 5%. And just to put it into historical context, again, interest rate higher than 5% is something we haven't seen in almost 2 decades. So, I mean, these are truly historical moments. And it helps to take a step back to think about what is the fair value or what is kind of, I mean, where bond prices or bond yields are heading in the kind of medium to longer term. And the reason is this is not just relevant for bond investors. Even if you don't invest in bonds, if you invest in equities or other asset classes, bond yields are actually also very important because this is what we call the risk-free rate, right? Especially the US government bond yields. So everything else is in addition to the risk-free rate, what kind of return you're getting. So let's say, I mean, today you get the risk-free rate of, let's say, I mean, the 10-year treasury bond at 4.4%. So any kind of investment that you make, you need to ask yourself, can I actually make better return than that so-called risk-free rate?
Mm.
And of course, like the riskier the asset class is, the higher the return it should give to you. Just take very, very simple examples. If you look across a bond spectrum, so apart from changing the duration, which is that kind of the time frame of the bond, you can also move along the risk spectrum. So the risk-free interest rates would be US governments. And then if you want a bit more return with a bit more risk, then you go into investment grade corporates. Like these are very, very high quality companies. Things like McDonald's or Apple. I mean, they actually are very unlikely to default, which is why they call investment grade. So you get a bit of higher return from those investment grade bonds, right? Today you can get kind of roughly 5 to 6% return on these bonds. Now, if you want to get even more adventurous, if you want to get even higher return, then you go to the riskier corporates, right? These are called high yield, which are companies that have slightly higher risk of a default. And of course, and if you're an equities investor, that is even riskier than high yield bonds. So I mean, the return that you demand from investing in equities in general should be higher than the return that you demand from investing in bonds. So that's why that risk-free rate, that 4.5% or 5%, actually sets the tone for or the valuation for all the other asset classes, which is why everybody should care about or think about where the long-term rate is going. And I guess back to the question of where we think yields are headed. Today is actually a very good time to talk about it because yesterday we just published a CIO Insights piece, basically looking at where long-term bond yields should be in terms of fair value. And a way to think about bond yields, if you take that 5% in terms of 10-year bond yields, you can break it down into different components. The first component is the expected inflation over that 10-year period. Because for this risk-free rate, at least you need to get a return that's above your inflation rate. So let's say, historically speaking, inflation have averaged around 2%. And also, that's kind of the Fed's target. So let's say, we expect inflation going forward to average around 2% next year. Now, so out of that 5%, you get compensated for inflation for about 2%. There's still 3% left. The second component is what you call the term premium, which is actually the second component is what you call the real return. So this is the return that you demand above the inflation rate, and historically that has averaged around 0 to 1%. So let's add 1% to it. There's still about 2 to 2.5% of unexplained, return in that 5% bond yield. And that is what we call the term premium, which is the extra return that you demand for lending money to a U.S. government, like the U.S. government for the next 10 years. So perhaps so that is kind of the component where it has exploded in recent months. And one of the biggest reasons for that increase in that expected return or that required return is because the market has been very concerned about the US issuing tons of debt over the next 10 to 15 years to fund the government deficit. So we took basically a deep dive into what the market is already pricing in with that 2.5% term premium, and given the issuance schedule that we see over the next 10 to 15 years. And our conclusion is that, at that kind of at 2.5% term premium or at 5% long-term interest rates, the market is already pricing in quite a lot of these concerns about US issuance. We think at 5%, actually interest rates become attractive to some of the very, very long-term bondholders like insurance or pension companies. So, all in all, we think 5% represents a fairly attractive valuation from a bond perspective. Now, of course, if you compare that with short-term interest rates, so very, very short dated US government bonds yielding 5.4, 5.5%. So, back to what Albert said, right? The yield curve is still inverted, meaning that the short-term rates are still much more attractive than the long-term rates. So given that, even though we think that long-term bonds are starting to get attractive, short-term rates is still offering you better returns. And hence, we still maintain an overweight of shorter dated bonds in our overall portfolio.
All right. Thanks, Stephanie. If any of you have questions here, please feel free to post them in the YouTube chat box, and we'll get to it afterwards. Stephanie, you briefly touched a little bit on term premium earlier, whereby essentially you are compensated with a higher return for investing in something with a longer maturity for bonds. Mm-hmm. On the back of this, we've seen the Fed put a hold in terms of its interest rate hikes, but inflation itself is still high, above what they deem as their 2%, the natural interest rate level. So given that their stance is to keep it on hold or essentially higher for longer, what does this mean for short-term bonds or and long-term bonds on the other end?
Yeah. So I think if we look at like what the Fed has communicated, basically what they said is because of the rise in long-term bonds, bond yields, actually, I mean, the market has done some tightening for the Fed already so that they don't have to tighten as much as they thought previously. So, I mean, the Fed is signaling very, very clearly that at this level of long-term bond yields, I mean, they're kind of putting the interest rate hike on hold. And if we look at historically, I mean, if you look at historical hiking and easing cycles, half of the time the Fed goes into easing immediately, and half of the time they put things on hold for a number of months. And on average, that comes out to be around 6 months. So, I mean, in this case, we don't think the Fed will start the easing cycle anytime soon. So they won't go into cutting right away because historically, when they went into cutting right away, it was to deal with some sort of crisis. And if you look around today, I think, I mean, the US economy has shown its resiliency, and there's no crisis that the Fed needs to fight. So very, very likely, I mean, they will keep rates at current level for a number of months. And I mean, just kind of on average, they've kept interest rates on hold for 6 months. And if you look at the Fed's own forecast, that actually also warrants them to be on hold for 6 months or slightly more, because if you look at their own forecast, I mean, they are forecasting inflation to come down, but still by the end of 2024, inflation is still way above their target of 2%. Secondly, I mean, they do foresee a slowdown in the U.S. economy, which is what we've been, I guess, saying as well. But if you look at their forecast of the U.S. economy next year, they expect a GDP growth of around 1.5 to 2%, and this is not a recession, right? A recession is a negative number, so this is still far from recession, although it is a significant slowdown from what we've experienced this year. So basically, I mean, what the Fed is painting, it's more like a what we so-called a soft landing scenario. And of course, I mean, like, this is their base case right now, and as data evolves, as things evolve, I mean, they may change their forecast. But I mean, we can understand like the Fed's thinking from looking at their own forecast of GDP as well as inflation.
Yeah, before I go to some questions which some of our audience are asking, I wanted to touch upon, given how much bonds have fallen, especially over the last 2 years, from a valuation perspective, doesn't that make them very attractive? What is ERA, which is our investment framework, saying about this? Should it not be something that can be very interesting as an asset class to invest into now, especially if we expect to potentially go into a recession?
Yes. So I think indeed we when we run our own valuation, like long-term bond valuation model, it is -1 as standard deviation, like kind of below historical average value. So like from a very long-term perspective, I think of course like the valuation looks quite attractive here. However, our ERA portfolio is still kind of more overweight short-dated bonds and cash-like instruments because of two things. Like, number one is that from a risk-adjusted basis, short-dated treasuries still give you way better risk-reward. And if you think about kind of risk-adjusted reward, you think about it in two components. The first one is the yield that you're getting. And as I said before, I mean, short-dated yields are still higher than long-dated yields. And then I think secondly, if you look at when you consider the risk-adjusted return, you also have to look at the volatility of the instrument. Now, long-dated bonds are still fairly volatile compared to the historical average. So I'm sure, I mean, some of us are very familiar with VIX, which measures the volatility of of equities. There's also an equivalent measure called the MOVE, MOVE, which measures the volatility of long-dated bonds. And the MOVE index is still fairly elevated. So it means that bonds are still kind of gyrating around in a much more volatile fashion than it historically has been. So I think for bonds, like for long-term bonds to become much more attractive from an ERA perspective, ideally, number one, it has a higher yield than the short-dated bonds, and then number two, its volatility actually starts to come down. So I think, as you mentioned, Albert, as we get closer and closer to recession, or as the economy slows down more and as inflation slows down further, then I mean, bonds will start to become more and more attractive. However, today, I think comparing short-dated and long-dated, the short-dated bonds actually still remains much more attractive.
Yep. Maybe I want just to expand a little bit more on that. When you say short-dated bonds are a bit more attractive, like what's the yield currently there right now?
So I mean, if you look at so we do have ETF instruments that track 0 to 3 month U.S. government bonds, and these are yielding around 5.4%. So it's still quite a bit higher than the 10-year and 30-year.
Yeah, so I think for our listeners here, if you're keen to have exposure to something like that, something short term, 0 to 3 months US Treasuries yielding about 5.4% right now, we have the portfolios available within the Stashaway app. It's called the US dollar cash yield portfolio, which just consists of one ETF that can give you US dollar exposure at 5.4% yield. Okay, just want to go into the questions by our audience here. It's coming in. The first question by Memento Mori here is asking, what is your outlook, Stephanie, on high yield bonds and senior leverage loans?
Yeah, I mean, it's a good question, and thank you for that question. I think in terms of the preference for along the corporate risk curve, I think actually IG offers investment grade actually offers better risk reward here, because number one, a lot of the return actually comes from duration. So already, as I said, right, like if you just buy US government bonds, you're already getting 4 to 5% yield. And if you look at the spread between IG versus government bonds, or high yield versus government bonds, or even senior loans versus government bonds, that spread is actually quite narrow, or it doesn't reflect any concern in the economy. Now, if we're right that next year the economy is going to slow down further, then that spread would actually start to widen. So I think sticking closer to the high quality bonds actually would provide the best risk reward. And I think if you look at IG, I think the risk of default in IG investment grade companies is still actually fairly low. We do get a slowdown, but it's not a deep recession.
All right. Another question by the same person is asking, what is our base case for interest rate cuts, and how would this affect Singapore itself in terms of Singapore interest rates and also mortgage rates?
Yeah, I think that's $1 million question. And I'll tell you like what the Fed is expecting and what the market is expecting right now. And then I'll comment on our thoughts on those. So if you look at the Fed's own forecast, they're forecasting interest rates to decrease to around 4.5% by the end of 2024. The market is actually a bit more dovish. The market actually expects the Fed to cut interest rates to around 4% by the end of next year. So these kind of projections actually reflect a slowdown but no recession scenario. Now, there are some sell-side economists that are calling for interest rates at 2% at the end of 2024. And in my view, that is actually a recessionary scenario. So what we think about interest rates actually depends on our view on whether or not the US will enter a deep recession. Just judging from, if you think about the various, channels that can trigger a recession, I think there's three main channels. The first one is a systemic risk, i.e. something blowing up. So something like the financial crisis, something like the Silicon Valley Bank, These are very, very specific situations that actually affects the whole banking system. And here, I think there's 2 points I want to make. Number one is that if you look around, I mean, there are some pockets of potential weakness, right, in the US. For example, the commercial real estate, for example, private credit or private equity. But I think, I mean, the size of those issues are not systemic, are not big enough to trigger a much bigger issue with the banking system, which is what the Fed is mostly caring about. And then I think, secondly, if you look at what happened during the SVB debacle, the Fed actually responded very, very quickly, right, to prevent it from spreading into a much bigger crisis. So I think given these, it's hard for me right now to see if there's any systemic risk arising from the US. Now, of course, like there's always things that could surprise on the downside. So never say never, but it looks like a lot of the risks are actually quite well understood. The second channel that can trigger a recession is actually on the employment side. And here, again, if you look at today's unemployment number, the latest unemployment number is still below 4%. And I mean, we're starting from a historically low level of unemployment. And one of the, I guess, structural issues about the labor, or explanation of why the labor market is so strong, as we pointed out in our Outlook piece a few months ago, is that post-COVID, a lot of people have left the workforce, like due to early retirement, etc. And these people are not coming back to work, which is why, I mean, the labor market in the US and other developed markets have been so strong and so tight. So unlikely we're going to see a significant spike in unemployment. Now, the third channel that can actually start a recession is U.S. corporates, right? Company earnings going into recession, and hence, I mean, they start to cut on their spending, investment. They start to cut people, right? And I think here is where I see more of a concern. And I mean, if we think about U.S. corporate earnings, I mean, this year they have surprised on the upside due to two things. Number one is inflation actually being higher. And because companies make earnings in dollars, right, in nominal terms. So when inflation is high but not super high, it actually means that company makes more dollars in return. The second thing, which is quite surprising to a lot of people, is that a lot of these companies actually benefited from the rate hike because they locked in their debt, the issuance at a very low rate. Let's say a company has 7 years of maturity in debt. I mean, they would be paying interest rates that are still fairly low and close to like 1% or so, but their cash is actually now earning a lot higher, right? Just like Stashaway customers, you can put your cash into these US dollar treasuries or money market funds, and you can get 5% yield. So net, some of these companies is actually benefiting from a higher interest rate. Now, next year, as interest rates start to perhaps roll over, inflation start to roll over, then I mean that the benefits that these corporates actually enjoy this year will unravel. So I'm more concerned about the corporate profits than the economy as a whole. So I think I'll actually do a bit of advertising here. We're going to be putting out our 2024 Outlook piece in about a month's time. So please stay tuned for more kind of in-depth analysis there.
Yep. So there you have it. Stay tuned for that 2024 market outlook by Steph. Just aware of time, but I want to answer one more question here from Enel itself. So he's asking, Stephanie, we talked about higher for longer earlier. Could you share your views on what that kind of environment would mean for the outlook on bond funds rather than specific bonds itself? And
Yes.
If there's any risk in particular for a bond fund that's especially made up of more long duration bonds?
Yes. So I think, I mean, of course, every bond fund is different. And it really depends on what kind of bond funds you're invested in. But I think a few key things to think about as we have this higher for longer environment is that number one, I think if given the choice of duration, of being shorter term or longer dated, the longer dated bonds are starting to become attractive, but as I said, I mean, it still remains quite volatile. So you should expect still like quite a bit of volatility in the bond funds that have a significant exposure to duration. And then secondly, I guess if the bond fund has exposure to riskier companies, I would be more concerned because I mean next year, if the economy continues to slow, some of these companies may have issues with not just their business, but also when they do refinancing of the debt, they need to pay a lot higher interest. So I think you need to actually look specifically at what the bond fund is consisting of. So yeah, I'll just stop here for comments.
All right. I don't seem to have any more questions for now, Stephanie. I guess you have answered everyone's questions. And with that, yep, I guess time has come to an end. I guess if any of you have further questions that you would like us to answer, please feel free to drop an email to us at support@stashaway.com and we'll get back to them. But in the meantime, thank you so much for dialing into today's session. Yeah, thank you, Stephanie. Thanks for your time, and
Yes.
thank you everyone else for dialing in.
Yeah, and happy Thanksgiving for those who are enjoying the turkey, and we'll see you in a month's time.
All right, take care, everybody. Bye
Thank
bye.
you. Bye bye.
We good?